Preparing.
There we go. It's being live streamed. Got it.
So you can take it back now.
How's that?
Looks good.
All
Yeah,
right. Here we
preparing.
go. Very good.
Looks like you're live.
Okay. Awesome. Welcome, guys. Welcome, everyone. Today we've got an exciting podcast for you. I am in Phoenix, Arizona this week, and the show must go on. We've got a lot that has happened this week. Everything from the war in Israel to hearing from Jerome Powell that we are pausing rates, or at least we didn't do a rate hike. He did not say, and we'll talk about all that. We're not going to go into those details, but let's go ahead and get this thing launched. I'm going to throw up our disclaimer and intro video. That'll take us just a couple seconds here, and then we are going to be on our way. So let's go ahead and launch this. Share sound. And we're off. There's our disclaimer. Obviously, guys, find us on our socials, like, subscribe, show your support. We are jumping into an exciting week this week, and I have just so much to cover. Let's start, though, with our review. So we like to go into the beginning of the podcast doing a review on our last technical analysis, both on gold and on the S&P 500. And if you've been watching either of these, or just the markets in general, the S&P 500, you know this was an interesting week. And you know that what happened with the Fed pause rate, the market highly reacted to this. And so I want to bring those charts up. And what we're going to do really quickly for my listening audience, I'll do my best job to describe what's going on. But for my viewers, I want to show you exactly what's going on here and why. So let's go ahead and jump into our charts on green chart. And what we're going to do last week, so I drew these lines in, and for whatever reason, my line didn't save, but we did a technical analysis. And the last Friday, we had to kind of draw in these new channels that were going on to the bullish direction. And this was on gold. Now, if you remember last Friday, that was the 27th. And we were looking at this chart. And if you guys don't recall, and I'm just going to move this for a minute so you guys can see it better, but we're going to zoom in. Last Friday, gold during that morning was at like 1950, 1940 price that morning while we were on. And we were drawing this channel. There's this non-linear support. So there's this kind of like wall that the price is climbing on, this ladder, so to speak, that it's climbing. And the slope was really steep. But we said because of the bullish attitude or sentiment, while also being above this 1973 or this $1,973 price for gold, what it's created is this pressure to break. And we've always talked about this, and we talked about it last Friday, that the 2000 level was going to be very significant resistance. It always has been, but within one day, right after our webinar, it not only bounced for our viewers, you can see this candle, it not only bounced off our nonlinear support, it also stayed above the 1973 level. But once it hit 2000, it really, like the next day, which was Monday, then Tuesday, and then Wednesday, we saw this kind of bearish run right back to our 1973 level. So guys, I look at this and I go, one, we had some great trade opportunities on Friday, which definitely went the direction that we thought. Monday came in, we got some news and sentiment, and the 2000 technical level that it pushed up against, and it just came down. You can see it very clear here. So there were, just using our technical analysis from Friday, obviously you'd want to update this and make changes as you go through the week, but just from Friday's analysis, you probably had 1, 2, 3, 4 trades just inside of our support and resistance levels, and this breakout from our channel, or you could say this trend that we've had over the last 3 weeks. So there's gold. Let's jump over really quick to S&P 500. I'm going to switch this up so we can see it better. And it's the same story. We set you guys up so well on the S&P 500. I want to show you this. And again, I'm going to have to kind of show how this chart works, because we had this change. And let me just kind of mark where last Friday was. Last Friday was the 27th. And it should be, that's the 20th. Right there. We're going to zoom in so we can see it really well. And you can see we marked this, and we had S&P 500 coming down into that day, and we marked this 4107 price as support. And we were also at the bottom, like we talked, and we're going to have to make some adjustments. We will when we do this trade later. But we were clearly at the bottom of this kind of channel, or this stair stepping that was happening towards the down, or the bearish direction. And so last Friday, so we had to get rid of this. This was from before. Got to make sure to save these. Last Friday, we saw this and we said, you know what, based on this support, it's going to be very likely that we're going to have price movement into this channel. And what did we have? Literally bull, bull, bull. 3 posted days, Monday, Tuesday, and Wednesday, bull, as this 4107 level held. And then we've got this new channel that's going into the upside. But as we adjust this, you'll be able to see that we're kind of within that price range. So we're going to be likely pushing up against some resistance again, just from a technical level. But we'll go over that towards the end of the training. So that's a review, our recap from last week. You can see how these technical levels just make such a huge difference in your trading. It's a way to go out and impress your friends. But yeah, we'll keep you guys updated on this, and we'll do an actual analysis and trade later today. So I want to dive into the news side, because we've had a lot that's happened over the news. And before I do this, I want to also bring up a tool that maybe many of you haven't seen. We like to use our economic calendar throughout the week. And last week, Friday, Federal Chair Jerome Powell, let's see if I can go back. Let's go back to here was interest rates. Well, this isn't gonna, it's gonna, all it's gonna show is the speech. But yesterday we had consumer confidence pretty high. I'm just looking at this really quick, guys. Initial jobless claims, nothing too alarming. The only thing that, let me just bring this up so that you can see it. I want to go over what's happened this week in terms of data, because it's been a really interesting week. A lot of mixed data, and how we're reacting to it is really fascinating. We got major bull runs in the market because Jerome Powell comes out and says, hey, we're going to pause rates. We're no longer going to do increases. But he also left a lot of room on the table for increases in the future. And with inflation, which we'll talk about, inflation still on the rise, we might be at that point where the plane's coming down for the soft landing, and it's going to be really long and really slow before it touches down. Now, yesterday we had CPI come in high. The impact, the actual, was less than forecast. We also had initial jobless claims, which is the one I'm watching the most. And if you remember, the week before we had bad news on this, and yesterday we did also. We were predicting about 210,000. It came in 7 over, which is enormous, guys. This is the data point. This is the one card in this house of cards that I feel like is the weakest, because all the other data points are already weak. And once this one starts inflecting over the next couple of weeks, I'll be watching and reporting and telling you kind of when that number clicks over to a point that it becomes a concern, where we might see a major tipping point in some markets. All right, so there's that. Let's jump in really quick. I want to show you this article. Let's see if I can bring this up really quick, because I think it's important to understand what's going on here. So this is, just bring this up over here. There we go. So this was a video where Biden got interrupted by a protester calling for a ceasefire. And this, what he said in response, has been taken across the world, the globe, whether it was intentional or not. And the language is also very unique and clever. And so I thought it'd be fun to watch this. Let me make sure that the audio is connected. Oh, yeah, it's connected. So here's this person here. We're going to watch this really quick.
Very fine people on both sides. When I heard that, I knew.
Mr. President, if
Oh
you
my
care
God.
about Jewish people, as a rabbi, I need you to call for a ceasefire right now.
Very fine people on both sides. When I heard that, I knew.
Mr. President, if
Oh
you
my
care
God.
about Jewish people, as a rabbi.
So as a response to this, rather than saying we are going to have a ceasefire, the president did make comments that and asked for a pause, not a ceasefire, which I don't know what a pause would be, but I'm no expert on the war going on in Israel right now. The conflict goes back centuries, guys. And something I would touch on is the reason Israel isn't going to do a ceasefire, and they've actually come out and said this, is a ceasefire would be a surrender. A ceasefire would be an acknowledgement of a loss or a victory. And right now, the troops are in their city. They're not going to do a ceasefire because they're literally trying to eradicate the damage that's been caused to them. And I think any country, anywhere would react this way. And so there's not going to be a ceasefire. And I think the president is kind of not being direct and kind of treading this thin ice, not to upset either side, because this is kind of this proxy war that the U.S. got itself into. And frankly, instead of a ceasefire, saying a pause, which it's like, what does that even mean? What does a pause in the war mean? It's like for a day, what are we pausing? So really interesting way to kind of phrase this. But the reason I bring up the war in Israel, Hamas, and Hamas, I should say, is this has global impacts, and it will affect other nations. And right now, I'm watching really closely to see if things are escalating or de-escalating, because an escalation, whether it's nuclear, whether it's Iran, whether it's Russia, whether it's China, and we're seeing all of them kind of commenting and lightly, I would say, taking sides, but the de-escalation has been more noteworthy than not. And the news obviously doesn't get clicks talking about de-escalation. But what I will say is what's not happening. There's a lot that's not happening that's positive news. There's a lot of allies who aren't coming in and saying, hey, we're going to provide additional support. There's not a lot of taking sides that's happening. There's not a lot of sanctions that are happening. There's not a lot of tariffs that are happening yet. There's a lot of let's just sit back and kind of let this problem de-escalate while Israel and their troops go in to kind of regain the territory, which they have been doing. There's been some movement that way. All right, so now kind of moving past the global economic chaos that's going on right now, not to mention we're still in a proxy war with Ukraine, right? This war with Ukraine has not ended while we're dealing with this attack against the Israeli people. We are dealing with our own problems here in the US. And one of those problems is inflation. And I want to share with you a couple charts and a couple things that I thought was just fascinating. And so we're going to bring this up really quick. And for my listener audience, I'm going to do the best job I can to describe what exactly you guys are seeing here. But we're going to talk a little bit about inflation. I'm going to start to tie a story together that's going to play into how 2024 may or may not play out based on the data that's coming in. So I'm going to set you up. I'm going to tee you up to be prepared, because there's one major saying right now that I really believe when things get to be uncertain, and that is that those who pretend, or those who claim to have certainty, or are completely lackadaisical, lose in this type of market. The skeptical and the paranoid do the best. And so just keep that in mind. If you're feeling a level of anxiety or paranoia about the market right now, my response to that would be good. Like, thank goodness someone is paying attention. Because if you're not, if you're complacent right now, or the opposite, too confident, you are likely in a position to lose. And that's the psychological tip for the training today, is find, especially in markets like this, find yourself a little more, be okay being a little more paranoid, a little more skeptical, a little less easily persuaded, and definitely do not give in to complacency right now, guys. The VIX, where the VIX is right now, is a clear sign that there's a lot of complacency in the market. And I think it's completely inappropriate, meaning there's a lot that's going to happen that's going to affect these things. So I wanted to show you this because this is a inflation report that is out of our country, but there's some data points here for US inflation also that I think is important. And I want to talk about how this 5% number is kind of psychologically detrimental once we start going over it. And that includes interest rates, that includes CPI, like all the numbers. This like 5% is this problematic number. But if you look here, I want to show you actual inflation year over year. And what I like about this chart that is different from some of the charts I've shown you guys in the past is this is year over year change in CPI. And the two numbers or colors that you're seeing, if you look at the bottom of the chart, is inflation, and then inflation excluding energy and motor fuels. So inflation year over year, or change in the consumer price index, if you were to take out energy and motor fuels, is higher. If you include energy and motor fuels, for the first time ever, inflation year over year has deflated. So we've gone through a year over year deflation of negative 0.4%. Now, a lot of you guys are going, what? That makes no sense. Things are higher. Things cost more. I'm feeling it more. And it's like, well, that's because actual inflation, they actually don't include oil. They actually don't include these cost of living. I mean, it's just bizarre, these things that we include in our inflationary numbers. But for some reason, oil and energy and cost of living, most importantly, cost of living, energy and oil are included, but cost of living isn't. And it's like, this is a cost for every American in this country, is how much does it cost to rent? How much does it cost to buy? And how much does it cost to maintain wherever it is your standard of living is? So very interesting data points. My only comment on this is you can clearly see we're on the downturn. However, do you guys know when recessions start? This is a key moment takeaway from this training. Recessions start after inflation is over and we've raised rates. So typically a recession hits when we pause or drop rates for the first time after a major rate hike. And as you know, from my last podcast episode, we just talked about how we increased rates faster than we ever have over the last, don't quote me on this, but I believe the chart said 35 years. And now here we are, finally in you would call a deflationary period. And what comes next every time? A recession. Now, a lot of you guys are going to argue with me. Well, Matt, we're already in a recession, right? And it's like, no, we're not. A recession is actually calculable. It's an equation. It pulls in data points. And we're not in a recession because of inflation. And once GDP is adjusted for inflation, we have this massive problem where it looks good on paper, right? Your stocks look good on paper. Your equity in your home looks good on paper. Everything looks good on paper. But in reality, because of inflation, once you adjust, you actually see reality. And it's like, whoa, we're actually in the negative. After all the inflation that's happened, like we talked about last week, 17+% over 3 years. If your assets haven't grown that much in those 3-year period, if your home value, whatever, just fill in the blank, you're in a recession on that asset class. Well, the economy is in a similar state. However, it's not adjusted for inflation. And so once we get inflation down, it's typically when you see those small windows of recessions come in. So it's my prediction, and again, not trade advice, you guys know this, but my prediction is into next year, we're going into a recession. I don't see how we can't. And that's not bad news. It means we're going through the last cycle of taming this inflation, monetary reform to get, basically the dollar stabilized from all this spending, all this extra spending that we've done. All right. I wanted to show you this also. This is an interesting chart. Short-term price trends. According to the flash estimate, consumer price rose 0.5% in October relative to September. So we just went from this chart where it's like we're definitely in a deflationary period, but consumer prices of goods went up went up 0.5% from last month to this month. So year over year looks good because last year was pretty high still with inflation. Month over month, we just saw a bump up. So here's how I would describe this visually. Everyone describes inflation and all these inflationary pieces like a plane coming down on a landing strip. And I think it's actually a decent analogy. But what's happening right now is our inflationary plane, if we were to go back up to this chart, you could literally say the plane took off, the plane's coming down for its landing. How is it going to land? Well, like a plane, you typically start really flat and then take off slowly, and then you get your incline once you're in the air. In the same way, when you're coming down in a plane, and I just did this flying into Arizona, you come down, you decelerate pretty quickly, but then once you get within a certain range, you typically slow the pace of your deceleration down. And at the very end, you do it the most because now you're moving more forward and you're really trying to bring the plane down in a way that's not going to disrupt the passengers. Well, that's what Jerome Powell is trying to do right now. He's trying to get inflation down without causing too much of a recession, without causing all these deflationary measures like housing market crashes like we had in the last market, or dot-com crashes like we had in 2001. And if you look at this chart, what I'm seeing is soft landing is not far off, even though we had a slight 0.5% increase in consumer prices over month. It's kind of like the plane coming down. And if you've ever been on that plane, like at that last moment where the tip kind of comes up and maybe you elevate a little bit before you're landing, I would say that's what's happening here. I would say that's what's attempting to happen. And how the Federal Reserve reacts to this, which I think a no rate hike was appropriate, will allow room for adjustment as the plane starts to touch down and we try to make good contact with the pavement. All right, I wanted to talk about a couple other things about the CPI. I thought this data was really interesting. If you look at, this is annual rate of change of product groups. And CPI takes in multiple numbers. And as you guys saw in the economic calendar that I showed previous, CPI is something that's reported on very regularly. And this report shows it kind of broken down and where there's the most impact, where food, beverages, tobacco has gone significantly up year over year, almost 8 to 10%. So if you're going, gosh, it feels like food is so much more expensive than it was last year, it's because it is about 10%. If you're feeling like your beverages, or maybe you're a smoker or you consume tobacco, gosh, it feels like those costs have gone up, it's because it has. Where energy, like electricity, motor fuels, has dropped significantly year over year. And then non-industrial goods has gone up, and anyone who's gone out to try to find a handyman or someone out there to do work on your house or your business or even your car for that matter, the demand is still pretty high. And so those services have gone up in October and September. So this is where you're seeing where inflation is coming in from, where we're seeing some deflationary things happening. But you can see that it's not all the same. It's not like when one thing climbs, the other thing climbs at the same rate. You can see that there are certain asset classes that just don't do that. They don't follow these trends. Okay, I think that was it on this one. Let's move into my next data piece. And this is all going to start to tie in to my conclusion of what next year is going to look like, as there's going to be massive opportunities. In fact, how many of you guys remember 2008 and the housing market crash and how fearful, how paranoid, well, paranoid's not a great word, how complacent people were before the 2008 housing market crash? And then after about 2010 to 2012, how many of you had this thought of like, gosh, I wish I had just leveraged everything I owned and bought every piece of property that I could have during that time period? Like I've said that multiple times. And I did, I got into my own home and we bought some other real estate. I got into some commercial stuff. However, I wish I had just leveraged it completely, because of the deceleration and the deflation that happened in the market. And what I'm positioning for, what I am proposing, in conflict with a lot of analysts, a lot of people. And by the way, they're changing their tune also. I was telling you guys about Barbara Corcoran, how she got on during the pandemic and was like, oh yeah, commercial real estate is struggling, but residential, you don't need to worry about that. Well, literally last month, she changed her tone on that. And it's because she knows she's wrong. She knows that the housing market's cooling. She knows there's price decreases happening in the market. And next week, I will be going over residential real estate in depth with all my charts, all my analysis. And we are going into obviously a winter, so there's some seasonality things going on, but supply is coming up, demand is dropping, and we're seeing price cuts across the nation right now. But aside from that, what I want you to see is I'm going to start painting a picture about how the banks are going to have to deal with a lot of these adjustments and deflationary issues. How Jamie Dimon's play that just happened is largely, in my opinion, is a sign. Like if you're a CEO of one of the largest banks, right, JP Morgan Chase, and you make a personal trade, I think that's pretty revealing on how things are going. And then office occupancy, we're going to talk about the CRE market. So we're really looking not so much today at residential real estate, but we are going to do a commercial real estate weave, because I think it plays into 2024 really well. And so we're going to start with this. Let me bring this article up just to kind of highlight a point. And what we're looking at here, folks, is the bank exposures to CRE. And I really enjoyed this article. And one of the reasons was that they really highlighted the total asset class, where most people aren't talking about like how big of a problem is this. And so I just want to highlight this right here out of this article, that total bank exposure to commercial real estate across the country is currently at $3.6 trillion. 3.6. That's bigger than the stimulus and all the M2 injection that we did. This is enormous. And it's estimated to be 20% of their deposits, according to a recent analysis of the Wall Street Journal. And holdings by CMBS's loans that are non-bank type lenders accounted for $623 billion. And I know about this too, because I'm one of these lenders. I'm part of this group, right? Because if you're an investor and you're acting as the cash for a deal or whatever, you're gonna typically fit into this category. The reason that this is a big deal, and we're gonna have to move pretty quick on this, guys. The reason this is a big deal is because Jamie Dimon, who happens to own one of these banks, well, he doesn't own, but has a significant share value in one of these banks, and is the CEO of JP Morgan Chase just came out and said that he is selling a significant 1 million of his shares, which is, according to this article, let's see if I can find it, how much it's going to be. $141 million. So this sale that he's saying he's doing for his family, and by the way, the interesting news that's coming out around all of this, the news that's saying like, oh, this is not irregular, this is not, well, then why wouldn't he hold it? If he didn't think that the value of JP Morgan Chase wasn't going to go down next year, why wouldn't he be holding this? And what does he know about the internal structure of the bank? Or maybe the bank, maybe JP Morgan Chase is fine, but some of these other banks that are holding CREs are in trouble. And because of that, the commercial real estate market, not a matter of if, it's just when they have to refinance and deal with these occupancy drops, are going to have to finally have this coming to Jesus moment where they wake up and go, oh my gosh, we can't do this. We're going to have to close down shop or give the keys back to the bank. So I want to show you this chart. This is where we're leading to. Let's see if I can pull this up. Yeah. Oh my gosh. This chart. And I really appreciate this. There's a website called Castle. And Castle Systems does data on commercial safety. And so this is a occupancy report that shows national occupancy over 2,600 buildings in 138 cities. And Castle they're showing what is the back to work barometer. You know, if there's a temperature for if are people coming back to work and when, and obviously butts and seats impacts like these huge high rises in these cities. Well, how full are they? Well, right now, nationally, I don't know if you guys knew this, 50% occupancy compared to pre-pandemic levels. Still, we have not, people are saying, oh, people are coming back to work, but no. Either one of two things are happening. Either one, we've shifted the at-home work idea, or two, these companies are just not hiring these people back. And so this shows where we're at month to month, week to week. We're about 50%, but this is the chart I want you to see. Look at this chart. This is where we were in 2020 at about 100% occupancy, meaning those big buildings that we had everywhere had these, they were just full. People were working in them. I remember my whole staff, we had tons of square footage, right? Even since the pandemic, we've downsized because people they work from home. We don't have the demand for it. Well, we've been climbing back up since 2020 through the pandemic, but it hit about, we're about 50%, like we talked about. And depending on the city, some are way better or way worse. But this slope does not look like we're going back to 100% anytime soon. And the timing on this for next year, 2024, is imperative. We needed these to go back to full occupancy. This is how you the word is stabilize, but this is how you stabilize properties, is you get about 90+% occupancy, because that's the number that makes the whole project work. If you don't have 90% occupancy, if you don't have 90% of the people there, then your rents that would normally come in to pay those, they're non-existent. And so if you had a building, let me just play with this for just a second. If you had a building and you had to make a payment of $10,000 a month for this, and you got 90% gets you to about $12,000. So you have about a $2,000 margin. Well, if you drop to 50%, that would take you to $6,000. So now you're making $6,000. You've got a $10,000 payment, and just play with this for a minute. And occupancy is now at 50%. And next year, sorry, bad news, you have to refinance. And a huge amount of these CRE loans, because we don't do commercial loans, guys, in 10, 20, 30-year loans. No one does that. Everyone does them in 3, 5, maybe 7-year increments. They're ARM loans. The same type of loan that got us into the housing market crash in 2008, right? They're these adjustable loans that happen. And it's just common. This is what we've done in commercial real estate for years, decades. And so what happens next year when now I'm only making 6,000, I owe 10,000 every month, and I have to refinance. So now my 10,000 is going to go to 12,000 and I'm only making 6. It's just, it adds injury to insult. And this is what's stacking up into next year. And this is why I showed guys like Jamie Dimon are going, I'm selling my bank shares right now, because whether or not JP Morgan Chase is going to deal with some of these issues or not, I don't know. But some of the banks and their CRE holdings are significant, way over leveraged. They like the problem with Silicon Valley Bank was a lot of these commercial loans. The problem with a lot of the bank failures we had this year were because of commercial loans, and they didn't even have to refinance yet. That's happening this next year. That's happening into 2024. So hopefully a lot of these guys got things refinanced. So hopefully they've got their books balanced out, but I just do not see how this is going to play out well into 2024, guys. So I am running out of battery, but not just that. I'm at the end of our news. So we're going to go into our S&P 500 trade. We're going to go into our gold trade. We're going to set those up, and then we're going to let you guys get to the rest of your weekend. So let's do this really quickly before this dies. Thanks for being on here, by the way. Love doing this with you. Here's our gold trade. I'm going to go through this really quick. Again, not financial advice. Do you guys own research? But here's Friday. Here's our technicals. We are out of this channel. I'm going to back this way up to see if we're in a bigger channel somewhere. We're not. So we're kind of in this new price point. And because we haven't set a significant down or up trend yet, I'm going to actually go in and delete our old trend so that we are not distracted by this. And so here is gold. And if I were to guess, and I don't like guessing, but if I were to guess, just looking at the candles, we are likely in a consolidation period, meaning that things are consolidating. We hit that 2,000 level, which gold just doesn't like that price. There's so many trades at 2,000 pushing this price down. If I were just to do a really quick analysis on where this is going, it's going to want to play here for a while. It's going to want to play here for at least a couple of days, so maybe 2 days, market like this. And then after that, and when I say this for our non-viewers, this is between the price of 1973 and 2000. It's just from a technical standpoint, not fundamental. Obviously, if we get some news that the world's going to end, gold prices are going to go through the roof. You need to be aware of that. And then you're dealing with the 2049 support, and above that, we have no support. There's just nothing above that. Below, though, we've got this 1882 level. So if these break, I'm just going to show kind of how they would play out. If this was to break either of these levels, you're going to have price movements into this area. Probably not very significant, but more so on the downside than on the upside. And it's just because of the technical levels. Make this a little skinnier. So here's what the breakouts would look like. Thinner to the upside. And this is all technical. Fatter on the downside, but mostly sideways. If I were to say what next week's going to look like, I would predict based on this analysis, sideways movement on gold. All right, so let's save that. Let's move over to our S&P 500 trade. Let's give you guys an analysis on this, and then I'm going to let you guys go before my computer dies. And here's our chart. Here's the day. We are in a new trend and channel, so I'm going to quickly draw this up for you guys. Let's bring this back. Let's get rid of a couple tools that we're not going to need. We're going to adjust this channel, the large channel we're in also. But this is very steep. This is something very similar to what gold did. You guys remember this? This upward pressure into gold. But I got to zoom out and bring this channel down a little bit to adjust. I like that. So here's what we're up against on the S&P 500. We broke the 43.31 levels. Unless we get some bad news, this no interest rate hike is driving a lot of dollars out of people's savings accounts, out of money market accounts, and back into the market. I would say a lot of this is our retail traders, probably not large institutional traders. However, here's how I would draw this up. We've got room to the top of the channel. We also have significant resistance at the 4,473 level. If I were to draw this in for Monday, Monday's likely going to live in this space here. Come on. Don't be shy. Doesn't like me drawing on top of each other. There we go. So Monday's likely to live in kind of this space here. So I'm going to draw this over. And then Tuesday, through the rest of the week, we're kind of looking at a price action that's likely going to live in here. But you've got this downward pressure from this channel. So don't discredit that. Don't set your take profits, way into the 440 or the 4,473 level. You really want to be cautious of this. And so looking at the trade setup, you could have take profits definitely towards the bull side, set your stops below the 43.31 level. But if we get up to the top of this channel, I would be a little bit more bearish technically, and I'd be setting my stop above wherever the price is as this kind of delineates. It comes down over the next couple of days because this resistance is somewhat sloped. So there you go, guys. That is our analysis on gold. I'm going to save this one also so we don't lose it. That's our analysis on the S&P 500 for next week. You'll probably be able to find a handful of trades just using these charts going into next week. But that wraps up our week. And looking forward to next week, because next week we're going into the real estate residential side. And I think you're not going to want to miss it. I already have the data. It's the 3rd, so I already have the data on this. You can go to my charts. I'll be updating it actually today. But next Friday, I'll be going over it conclusively, and I think you're going to want to see what's going on in the country. All right. Thanks so much for being on here, Market Pulse members, and we will see you